Hello, my name is Cory and this is my industry analysis. The first industry we're going to analyze today is the utility industry. The five companies we're going to analyze are Energy, Exelon, First Energy, American Electric Power Company, and OGE Energy Corporation. The first aspect I'm going to look at is the firm's liquidity. Liquidity is how a firm can pay for its liabilities with its assets. As you can tell, Energy and Exelon have a great current ratio, which means they can cover all their liabilities with their assets. Energy and Exelon were the most liquid of the five utility firms and were the only firms that were able to cover their current liabilities with their current assets. Energy's liquidity fell dramatically after 2010 because it purchased a new power facility. Some people say that it'd be bad, but I see it as a good thing because they're investing in the future and they're going to make more revenue because of that. Exelon's cash ratio also dropped in 2010 after it spent the cash on a new wind power initiative. The next aspect is their long-term solvency. Energy has the highest equity multiplier, or leverage, which carries with it more risk. With more risk, you have a chance for more reward. Energy's equity multiplier was 4.51. Exelon came in second at 3.98, but they have a much better debt-to-equity ratio. Energy's capital structure remained pretty consistent over the 5-year period that we analyzed. As you can tell, in 2008, their equity multiplier was 4.44, and they ended in 2012 at 4.62. And as their debt structure at 148.34 ended at 142.16. It's a sign of good management when their capital structure remains constant. Exelon uses less leverage, but is the only firm that has more equity than debt, and that has been paying off, its debt for over the 5-year period. They started in 2008 at 118.12 and ended in 2012 at 89.85. The next aspect is asset management. We're going to look at the total asset turnover ratio, and as you can tell, OGE actually has the best total asset turnover. But overall, the total asset turnover across the five firms decreased over the 5-year period. The next one is profitability. We're going to look at profit margin, return on assets, and return on equity. And one major cause of concern is a drop in 2012 in all three categories for Exelon and Energy. As you can tell, in 2011, they started at 12.18 and ended with 8.43 in profit margin. For return on assets, they started at 3.44 and ended at 2.07. And in return on equity, they started at 15.43 and ended at 9.33. The same thing goes for Exelon. They started at 13.09 and ended at 4.94. For their profit margin, return on assets decreased from 4.65 to 1.74, and the return on equity decreased a lot from 17.86 to 6.48. The last is market value. We're going to look at the price to earnings, which is the stock price versus the earnings, and the market to book. And I believe that OGE's price to earnings ratio is overvalued at 14.22. And Exelon has the best combination of a price to earning and market to book ratios, which shows that both investors and the market have view the firm favorably for now and its future. The best utility firm, in my opinion, was the Exelon Corp. I say this because they were the most liquid. They're using their cash for investments, which is going to turn into revenue in the future. They're eliminating debt, which I see as a good sign. They have stable asset management. They have the highest average profitability over the 5-year period. And the loss in profitability that we discussed earlier, I contributed to a merger they did with another energy company and a decision to move away from nuclear power in 2011, probably after the nuclear incident in Japan. They have the highest confidence from investors out of the 5 utility firms and the highest economic value added. Here's the economic value, or weighted average cost of capital. And right here you can see the economic value added is really high at $1,835,000,000. So they were by far the best firm in accordance to economic value added. For supply chain, we're just looking, as you can notice, they don't have any customers as in firms, because as a utility company, the customers are individual people, so you wouldn't list them there. But they do have, their two biggest suppliers were First Solar Incorporated and Navios Maritime. The second industry I'm going to analyze is the advertising industry. We're going to look at Lamar Advertising, Clear Channel Outdoor Holdings, CBS Cory, Charter Communications, and Velasquez Communications. We're going to look at liquidity again, and as you can tell, the liquidity is a little bit lower than it was in the utility industry, but the average liquidity ratios I found were a little misleading. Out of all 5 industries, CBS was the only firm to experience an increase in liquidity and always had enough current assets to cover its liabilities. The other 4 firms were more volatile, but not necessarily had bad liquidity, with the exception of Charter, who declared bankruptcy in 2009. In terms of long-term solvency, Velasquez had a ridiculously high equity multiplier and also a very high debt to equity. Although CBS's equity multiplier may seem low compared to the other firms, when coupled with their relatively low debt to equity, I believe that it shows that management is doing a good job of keeping CBS's capital structure stable, which I think is a good thing if you look at it from an investor's standpoint. Velasquez's average debt equity is not a clear picture of how the firm looks today. As you can tell, the debt to equity is 4,190. They actually paid off a massive amount of debt in 2008 and continued in 2009. So their actual debt to equity is getting a little and very much more reasonable, as it started out at 22,212 and then dropped down to 1,033. In terms of asset management, Velasquez by far surpassed any of the other firms, which means they're, with the exception of Charter, the other firms seem to manage their assets effectively. Although you can't tell by the average total asset turnover, but Charter only had 2 years of data because they did declare bankruptcy. Profitability. The average profitability looks horrible because it takes into account the recession. The recession in 2008 affected the advertising firms the most because it's not really that the advertising themselves was the problem, but when your customers, the people you're doing the advertising for, they're having problems with the recession, the first thing they're going to cut is advertising. CBS and Velasquez both recovered well from the recession, so I'm going to go in more depth. As you can tell, CBS profit margin was negative 83.68 in 2008 at the height of the recession, and the return on assets and return on equity were also in the negative. But as you can tell, in 2009, they were able to pull it out of the negative and have been increasing in all 3 categories ever since. Velasquez also started out in the negatives for all 3 categories, but as you can tell, they came out to 2.98 profit margin, 3.71 in return on assets, and a whopping 129.3 in return on equity. In 2010, they increased in both profit margin and return on assets, but they decreased slightly in return on equity. The only concern I had was the massive drop in return on equity from 2010 to 2011, from 122.99 to 7.36. I saw CBS as actually having a more stable profitability, and that to me was more attractive. In terms of market value, Lamar had a way overinflated price to earnings ratio, but their market to book was average when compared to the other firms. Further analysis shows that although CBS is a low average market to book ratio, the market is actually gaining confidence over the 5-year period. So that was attractive to me, even though it does have a pretty low market to book, which says that the market doesn't have a good outlook for the future, but I disagree. Clear Channel and Lamar both have good market to book ratios, but their price to earnings are significantly higher, making me believe they're overvalued and not the best investments. Although Velasquez does have the highest average market to book ratio, it actually declined every year since 2008, with the exception of 2012 where it rose slightly. This indicates that the market has been losing confidence in the firm. So that raised some concerns. So in my opinion, CBS Cory was the best advertising firm. They were the only firm to improve their liquidity. They had low leverage, which means low risk, but it also means it puts a limit to their revenue. But they've also been paying off debt. They had a rising cash flow at the same time as they were decreasing their debt, which is very attractive to investors. They had the highest profit margin in 2012, and although it didn't have the highest return on assets or return on equity, it was consistently second behind Velasquez every year, and has been improving every year since the recession, which is something that none of the other firms could say. They were viewed the most favorably by the market in 2012 and have been consistently improving, and they have the highest economic value added among the advertising firms. As you can tell, economic value added wasn't as high as it was in the utility industry at 160 million, but it was still higher than any of the other firms in the advertising. And as you can tell, they have suppliers and customers. Their biggest supplier was Gray Television, and that was really all I could say about that. The last industry is the maritime industry. We're going to look at Hornbeck,